Welcome to the Private Lenders Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, Chris and Jason here, Private Lenders Podcast. Thanks for checking out the show. We are here to report on some recent industry news. There is a big time fraud that has shaken up the DSCR market. In case you're not familiar, DSCR, or also called Rental 30, is a loan product that is basically for rental properties, for residential rental properties. And I want to start by saying this is a necessary product in my opinion. When it came out a handful of years ago, I thought that was a smart thing to do. It should be in the industry. Banks and conventional lenders, I don't think did a good job of serving that market. Investment property refis, properties rented out, what are the terms going to be? What kind of documentation is required? I thought that conventional lending, their focus is homeowner stuff, right? And so like their investor products were never that attractive. I remember it from back in our banking days. So I just want to throw that out there first, that I think DSCR should be around. It might need to adjust because of what's happened, but we're going to break it all down for you today.
Yeah. So a few things were floating around over the last 2 weeks, mostly in the Baltimore area, which is one of the major markets that we cover. I'm curious, and please comment on this video or this podcast episode if this has affected your market, because I'm guessing this is going to spread in other markets. But we'll break this down, but kind of on a broad level, there was about $50 million worth of DSCR loans that were fraudulent. And Apollo was the end capital provider, investor in them. I think. See, here's the thing. I don't want to necessarily call out some lenders that I know that were involved or some brokers that were involved because it was hearsay. But I do believe Apollo was in that one article. Is that right, Chris?
Yeah, they put that out publicly.
Okay, they put that out publicly. There's some other local lenders, local brokers and lenders that we're aware of that had brokered the loan to the capital investor. And then the capital investor, or to the lender, I should say, and then the lender sold them to Apollo. I don't know how many other parties were involved between then, but in essence, the reason why these were scammy was they were fraudulent, inflated appraisals, and there was a bunch of appraisal companies
engineered by the borrower.
Engineered by the borrower. I think it was called like the 444, where in essence, anytime the appraisal company saw a $444 payment, they were told to inflate that valuation.
To the tune of like, we've heard 350 loans, we've heard 750 loans, we've heard somewhere in the neighborhood of a $50 or $60 million worth of loans to the same borrower that was engineering this fraud. And it seems like they were also in cahoots with the end appraisers to get around that AMC part of it, to do exactly that, to inflate the appraisal value so they get a higher loan amount on a cash out. And it looks like they kept the loans performing for a while, but recently defaulted and declared bankruptcy. And so this whole chunk of loans, $50-60 million worth of loans, several hundred, that had been securitized and sold to the secondary market, all started defaulting at the same time. It's like, what is going on? And Apollo is huge private equity. Like, they're smart money out of New York. They dug into it and they uncovered the whole fraud story. So a couple other things to add is that, and we've talked to other lenders over the past week. People here in the area have been talking about it. It's affected, I don't know exactly how many metropolitan areas, but DSCR lenders, we don't do DSCR loans, right? I think a lot of people in the Mastermind group don't either. That's more like being a mortgage company. It's like a low fee kind of thing. Like, we don't mess with anything institutional, including DSCR. But it does affect us as lenders because a lot of our borrowers who are buying and holding use DSCR as the takeout financing. So it does indirectly affect us. We don't really lend in Baltimore City, even though we're half an hour away from it. Our office is right in between DC and Baltimore. We've never been a Baltimore City lender. It's a very niche market. But other people we know around here are. And you want to tell the story about a lender who you spoke with and how this is kind of directly impacting them? Because they immediately slashed the LTVs. As soon as they found this out, Some people completely pulled out of the market, just like Kiabi did in Florida. We didn't totally know why. Completely pulled out of the market. And then some people just drastically reduced LTVs and possibly eliminated any cash out
Yep.
in response to this situation.
And we saw an article that Rock was pausing everything in Baltimore as well. I'm looking through this article, and anyone can search up this article. It's through National Mortgage Professional, and there's actually what are they called? Things that came out from actual Fannie Mae. Fannie Mae's not even really involved in this, but
they put out a fraud bulletin.
It in essence kind of reminded lenders and brokers for things to potentially look out for, and red flags and patterns and things like that. Because like it happens, and it happens to the biggest companies. And you know what I mean, think about this. It doesn't hurt. It doesn't help anybody to inflate values. It doesn't help anybody to, to do some of this stuff, because it hurts the whole real estate market, right? Like now, as of now, there's very few, if any, DSCR lenders even willing to touch anything in Baltimore. And you don't think that this is going to potentially undercover other portfolio areas where they're like, hey, maybe let's check out Philadelphia. Let's see how our loans are performing there. Let's see if there's any things that happen there, right? And then next thing you know, if there's no buyers for this, that whole area goes, and the housing, potentially the housing market declines. Good real estate investors that need and want DSCR loans, to expand their real estate portfolios, they might not have that, or the interest rates will go higher, and then it doesn't make sense to do so anyways. So a few bad actors, and we saw this, in the subprime world, 20 plus years ago. Is the same thing, and I actually saw it happen in Baltimore 20 plus years ago. The same exact thing, where appraisers were increasing values. I mean, there's so many lessons learn on this, not just obviously be a conservative lender, but like understanding the markets that you're in, because I can give you an example. Like there's areas of like Baltimore City that most of the reason we don't lend in Baltimore is it's not only a niche area, but like you got to be kind of like in the streets every day to know what's kind of going on. There's just so many moving pieces in there, and also just because we're a conservative lender by nature, we couldn't get the deals we wanted to get anyways, right? People are given 100% financing, high leverage, things like that. So we weren't able to get loans at the numbers that we wanted. But like, if you look on MLS and you look in some of these areas, and I'm like, okay, for this particular zip code, this particular area, there is solid comps at $300,000, right? I'm just using this as an example. And as an outsider looking in, like, no doubt, there's plenty of comps that support a $300,000 valuation. But I also know that most folks in those areas cannot afford a $300,000 mortgage, right? It's an area that just doesn't support it. There's certainly comps. And if there's, an institution, bank, lender that in essence is enabling homeowners, investors, by giving them loans at those amounts in those areas, that's going to increase, obviously increase the property values, and it's going to give the ability that more people are going to use those comps in order to buy in those particular areas, even if they're not affordable. So that's kind of what's happened. And to make it even worse, let's just say the value's 300. Well, if you have a fraudulent appraisal, it shows it's 350, and then the next one shows 360, 370, 380. That's not helping anybody long term, because nobody can afford them. And as fast as they increase in value, as fast as they go down. Let me say one other story, and then we'll get back to this local lender. So when we found out this happened, I dug pretty deep into tax records. I was using SFR analytics, I was using MLS, and I was using some other tax records to figure out who at volume could take down a big lender, right? And I came up with a few entities, and I'm like, man, it has to be this particular party, right? They own a ton of properties. They bought them all over them in the last 5 years. They've used huge institutional lenders. There's press releases related out of this. I'm talking in tunes of $100 million worth of loans in the last 5 years. And the crazy part is, I think I was wrong. It wasn't that party, because the criminal came out, the alleged criminal, I should say, was in this article that we found on National Mortgage Professional, and it was a different person. And then this person had also had 50, 60, 70, $80 million from institutional capital. I'm like, $200 million worth of capital deployed in DSCR loans only in these particular zip codes of Baltimore City. It's like, that's a ridiculous amount. That doesn't just move like a zip code or a county, or it moves everything. Like, it moves the meter crazy. So, okay. So this is what some local lenders had told me, which, some of the smaller local lenders, that have a few deals on their books, they have a few that potentially go bad and they're local in the area. They could take it over themselves. It might not be that bad. But like, if you have a lot of these going on, I don't know how you recover from them. This particular local lender told me that he had 2 or 3 properties that in essence were already renovated, ready to get rented out, about to go to closing. DSCR stopped. They're like, no, we can't do these anymore. And in essence, the borrower was like, cool, well, I don't know what to do at this point. I'll just give my properties back to the lender. Like, that's what the mentality was, which is a crazy mentality, because I feel like none of our borrowers, that have enough skin in the deal, good character borrowers that have a lot of skin in the deal, ever would think that, because it's like, why would I just give a property back to a lender? I have too much vested in this thing. I go sell it myself. But if you're a hard money lender and you're giving 100% financing, you give them 100% purchase, 100% construction, maybe even giving them 100% of the fees and the payments. I don't know. With the hope, and this is assuming they bought a pretty decent deal and there's built-in sweat equity, with the hope that, I'm just going to get a DSCR lender to do 80%, 30-year fix for them, and they can cash out me as the lender. They can, potentially even get cash in their pocket to move on, and they have no skin, they're recouping all of their equity as well. That's easy. And you keep doing those deals over and over until that DSCR loan stops. And in essence, for these borrowers to get out of these deals, they're fully renovated, ready to get rented out. They'd have to bring cash to the table because the LTVs get stripped by 10, 15, 20%.
Yep.
And then all of a sudden there's no out. So it's like, I'm not going to spend $30,000 to, get out of this deal. That doesn't make sense for them. That's just, I'm thinking as, what the borrower's notion would be. They're used to never putting money into a deal. As a lender, you're like, dude, this is ludicrous. Why would any lender give them such high leverage with no skin in the deal?
Right. But still, I mean, they were using the loan terms that were available to them. Like in this particular case, neither the lender nor his borrower were any kind of bad actors or doing anything shady.
That's right.
They were just using the terms that were available to them. And so normally, like say they're used to getting a $200K refi, take out refi, pay off the lender in full, and not have to bring any cash to closing, maybe even get a few bucks cash out, to now that loan amount's not 200, it's 175, for example. And they have to bring 25K to close on each refi. And in this particular case, the borrower, the real estate investor, called up the lender, the guy we know, and said, I'm not doing that, so let me deed these to you, which is pretty wild. And yeah, I mean, that's a very close to home example of how a market change like that can affect all of us, even though we don't do DSCR loans. It just has to do with our borrowers, their exit strategies, in the market in general. It's pretty wild, like how it all trickles down and can affect so many people when some shit goes down like that.
Yeah, I mean, I spoke to multiple lenders, and I think, and like, it's the same thing. And hoping others in the mastermind group hear this and, don't continue to do high leverage, because like stuff like this happens. No one would have guessed that DSCR loans would stop in a certain market because there was a fraud case that that was audited after the guy filed bankruptcy, and he's in foreclosure on all these properties, and they went to audit all the files, and then they found that out. Like, I think based on the article that we read, I think like they audited all of the files and were like, what did we do wrong here? And they realized what they did wrong there was fraud in all the appraisals. And they figured that out because there was a $444 appraisal fee on every single one of them. And that's how some detective auditor caught that, which is crazy. I mean, I still think that they probably overappraised them to begin with, not including the over appraisal, right? Like it was probably worth 300. They appraised them at 350, and it was probably really only worth 250. So we'll see what will happen with that. I mean, obviously you don't want anyone losing capital on something like this. And certainly not because fraud, but at the same time, we'll see. I mean, DSCR is a good product, and I know most lenders, including ourselves in the Mastermind group, at some point are doing loans where real estate investors are fixing properties to turn them into rentals. And
Sure.
but I also do believe that you got to be responsible, not just us as private capital lenders, but also lenders that are using institutional money, that you want to be, the first lender, we talk about this all the time, should never lose money. You should have the safest collateral position. You just should. You should have the safest collateral position. And guess what? Back in the day, Chris and I were talking about this the other day. Back in the day, if subprime loans were treated responsibly, that could still have been a product today. When I say responsibly, think about what subprime should have been back in the day. It was someone that couldn't necessarily use a traditional W-2 statement or a bank statement to show, or not bank statement, a tax return to show income, because they had a lot of losses, they had a lot of business losses. But at the same time, the intent was not to be able to give a loan to somebody who couldn't afford it. Greed turned into that. The intent was still for somebody to afford it, because I'm willing to bet that if a borrower who had good credit showed bank statements that showed they clearly have money coming in and out over and over and over, showed tax returns that had large losses, that in essence, but it still showed that they actually had income coming in, they just happened to write some of their passive and active losses, and had a big enough down payment, wouldn't be defaulting on loans, right? When was the last time someone who put up 30, 40, 50% defaulted on a loan? It happens all the time, but it doesn't happen at mass scale. If you're going to give somebody 100% financing or high leverage, and in this case, the DSCR lenders are giving cash out to them. So at the beginning, on the front end, they got 100% financing, plus on the back end, they got cash out into their pocket. They have nothing besides sweat equity. Think about that. That's the reason. And listen, a good actor that has the ability is not going to walk away from something, but unless they have to, right? I learned this a long time ago. Good people, good borrowers, they don't miss payments because they want to. They can't afford to. And in this case, they're walking away from these things, the good actors, because they just can't afford to. It's I don't have an extra $30,000 I can put into this deal just to keep it.
Right. Yeah, it started with the financing up front. And also another inherent problem in the whole thing is when Apollo or the other people who are involved down the line in doing those DSCR loans funded all of those, they only rely on the appraisal for their value. They go on one source of information for a value. It's the appraisal. And at that scale, they can't know it themselves. Their underwriters are not, it's not part of the process for the underwriters to start comping properties and come up with a solid value for this particular one. It's just not part of their process. They get appraisals, whatever the appraisal says, they use it. They might even get a second one, right? And then, use whatever the process is, but they have no knowledge themselves of the value of the property. And at that scale, you can. But the way we do this whole lending thing, it's not about massive scale and all of that and secondary market. It's about responsible lending, running it like an investment vehicle, not like a giant mortgage company, not doing crazy scale. We focus on profit margins, and it works well. It works well for us. It works well for others in the Mastermind group. That's how we have chosen to run our lending business, right? It works. It pays well. It's smart. We're staying out of trouble. That's the entire game plan. So if you haven't done so already, check out our Mastermind group, hardmoneymastermind.com. We hope to see you in there, and we'll see you here next time, Private Lenders Podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.